I'm Matt Bishard in San Francisco for NAREIT's REIT World, our 2018 annual conference. Joining me today is Ed Fritsch, President and CEO of Highwoods Properties. Ed, thanks so much for joining us.
Thank you, Matt.
Now, development's always been a core part of Highwoods' business. How's your current pipeline looking, and what impact do you anticipate in the coming year from rising costs and other demand or economic factors?
Yeah, you're right. Development has been a core discipline for us. We were founded 40 years ago this year as a developer. Our goal, our mission was to build out an office park. So we were bred as developers, and it's been a key part of what continues to drive our company's growth. We've been very fortunate with development, with a steady run of projects that we've been able to do. Our current pipeline is $658 million, 1.8 million square feet, and we're very fortunate that it's 96% pre-leased. So it's just a matter of time, taking pages off the calendar before that cash flow comes through the door. Construction continues to be more expensive to do. There's no doubt about that. That's something that's been a mainstay since really before the global financial crisis. It came through the crisis when you would have thought intuitively the prices were going down. They continued to go up throughout the downturn and then continued to escalate since then. We price a fair amount because of the volume that we're getting to do and the volume that we're pursuing right now, and we continue to see about 0.5% of escalation per month, and that really hasn't abated over the last 10 years. So it means that your prospect pool is more narrow because the cost of the rent is going to be higher. But we do think the footprint where our portfolio is, it's advantageous for us, and we continue to be able to attract businesses into our footprint and businesses that will grow once there.
Now, where is the company in terms of divesting non-core assets? And as you look to divest these assets, which types are you looking at, and how are you finding the market for them?
So we have been capital recyclers for some period of time. So we really launched into the project at the first of 2005, and from then until today, we've sold $2.6 billion worth of assets. Now we've turned around and bought $2 billion, and we've built $2 billion. So we've really changed the portfolio as a whole. So we think we're not necessarily a much bigger company, but a much better company from a portfolio perspective. So we do sell off the bottom. And we believe that there's no finish line in orchestrating your buildings top to bottom and force ranking them, and then looking at the bottom and saying, should we sell out of that and use those proceeds to fund development or other opportunities that may come our way. So we routinely are force ranking our portfolio. The market for us to sell into has been pretty strong. Obviously, they're not drawing the same cap rates that the top quartile would, but we continue to see cap rates in the 7 to 8.5% range, and we do see an active pool of buyers.
And lastly, in your latest earnings call, you talked about the importance of building a fortress-like balance sheet. Can you describe what that entails, and what are the challenges and opportunities that presents for the company?
So my definition, this layperson's definition of fortress is a couple aspects. One is low leverage. And so we're fortunate that our book leverage plus preferreds is 35.5%. Our debt plus preferred as a percent of EBITDA or versus EBITDA is 4.77 turns. So low leverage is an important aspect of it. Laddering, we don't have any one debt maturity that's very significant that we're worried about in a future year, that if we were to have a credit crunch that we have a heavy year or a heavy 2 years. So it's very evenly laddered, so we think that's an important aspect. We also have 217 in-service buildings, and only one of them is encumbered by a loan. So we have great flexibility with regard to recycling, with regard to being able to move customers and having the fungibility of the space. So not to be encumbered by a mortgage on those assets gives us tremendous flexibility just in doing day-to-day deals. And then last, it does give us flexibility to do things. So I mentioned in your prior question that we have $658 million in our development pipeline. About 50% of that is funded today. So at the 4.77 turn, if we funded the rest through debt, it would only take us to 5 turns. And if we did another $400 million, it would only take us to just under 5.5 turns. So we get the flexibility from the low leverage and be able to execute on our development side almost regardless of where the equity price is.
Ed, thank you so much for joining us.
Thank you, Matt.
For more from REIT World 2018, be sure to visit NAREIT's website, REIT.com.